All right, let's jump right in. Today we're tackling a big topic, something a lot of us think about, how to get our investments to actually pay us, generate some income. And we're going to do that by taking a really close look at one of the most popular tools out there for this exact job, the Vanguard High Dividend Yield ETF, or as pretty much everyone calls it, VYM.
So let's just start with the big picture, right? Usually when you think about investing, you're buying something, crossing your fingers, and hoping it's worth more down the road. But what if your portfolio could do more? What if it could be like this little cash machine, sending you money on a regular basis without you having to sell a single share? I mean, that's the whole dream of passive income, isn't it? And that's exactly what we're digging into today.
Okay, so Section 1, the search for income. For anyone really, whether you're retired or just want a little extra cash flow, dividends sound amazing. I mean, a company literally shares its profits with you. What's not to love? But here's where it gets tricky. How in the world do you pick the right companies? You pick one, and poof, they slash their dividend. You pick another, and it turns out their whole industry is struggling. It really can feel like you're trying to walk through a minefield blindfolded.
And that right there, that's the real challenge. You start trying to pick stocks yourself, and suddenly you're drowning in questions. Which ones have been paying out for years? Which ones are strong enough to keep paying if the economy takes a nosedive? And maybe the biggest question of all, how do you not bet the farm on just one or two companies? Because one wrong move and your income stream could just dry up. This is exactly the problem that a bundled solution, like an ETF, is designed to solve.
So that leads us right into Section 2. What is VYM? Well, VYM is one of the most popular answers to that whole minefield problem we just talked about. It's an ETF that was built from the ground up for one specific mission, to help investors who are hunting for that steady, reliable dividend income.
Okay, so what is it really? The easiest way to think about it is like a pre-packed shopping basket. Imagine instead of you having to go down every aisle of the stock market supermarket trying to figure out which dividend stocks to buy, Vanguard's already done the shopping for you. They've filled this one basket with hundreds of U.S. companies that are all known for one thing: paying out dividends that are better than average. So you buy just one share of VYM, and boom, you instantly own a small slice of every single company in that basket. Simple as that.
And listen, VYM is no spring chicken. It's been around since November 2006, so it has a really solid track record. And inside that basket we were talking about, you get a piece of around 440 different companies. That's some serious instant diversification. And here's the best part for income seekers. All the dividends from those 440 companies get collected and paid out to you, the shareholder, every single quarter, like clockwork. Now, if you want a sense of just how popular and trusted this fund is, just look at this number: $69.5 billion. That is a huge amount of money that investors have put into VYM. When you see a number that big, it tells you something. It means a ton of people, from small individual investors to big institutions, trust this thing as a key part of their strategy. It's a huge vote of confidence.
And now, let's look at the flip side of that massive number, a teeny tiny one that is just as important: 0.06%. That's the expense ratio, the fee you pay Vanguard each year. It is ridiculously low. Let me put it this way. For every $10,000 you invest, you're paying them just $6 a year to manage the whole thing. This is Vanguard's superpower, right? Keeping costs low so that more of your money and more of those dividends stay right where they belong, in your pocket.
So we know what it is, but how does a company actually get into this exclusive high dividend club? That's what we're going to look at now in Section 3. We're popping the hood to see how the VYM engine really works. It's not some secret sauce. It's actually a very clear, rules-based system. Step 1, they start with a giant list of U.S. stocks. Step 2, they immediately kick out a certain type of company called REITs. Now that's an interesting choice. They do that because REIT dividends are structured and taxed differently, and this keeps the fund focused purely on traditional company dividends. Step 3, they take all the remaining companies and line them up, ranking them by how much their dividend is expected to be in the next year. And finally, Step 4, they just draw a line right down the middle and pick the entire top half, all the companies with above-average dividend forecasts. That's it. It's systematic. No emotions involved.
And what you get from that process isn't a fund that's all in on just one industry. No way. VYM spreads the love across a whole bunch of different sectors. You've got big banks, you've got energy giants, you've got industrial companies, you've got consumer brands. They're all in there. And that's so important for risk management, because if one part of the economy, let's say energy, is having a rough patch, another part, maybe financials, could be booming. And that helps keep the whole fund a lot more stable.
And here's a look at some of the heavy hitters, the top holdings in VYM. I mean, these are names you see every day, right? A tech powerhouse like Broadcom, a banking giant like JP Chase, an energy leader like ExxonMobil, a healthcare staple like Johnson & Johnson, and of course, the retail king, Walmart. So when you buy one share of VYM, you're not just buying a fund, you're buying a piece of all these incredible, established, dividend-paying companies, and hundreds more just like them.
Okay, so we know how it's put together, we know what's inside, but the real $64,000 question is, how does it perform? And just as important, what are the risks? Time for a reality check in Section 4.
So let's look at some recent numbers. If we take the full year of 2023 as an example, VYM posted a really solid return of over 16%. What's more, it beat the average fund in its category, the other large value-focused funds out there. Now, you always got to have the disclaimer, right? Past performance doesn't guarantee future results. We all know that. But it does show that VYM has been a very strong player in its field. But income investing is a marathon, not a sprint. And here's where it gets really interesting. Even though VYM itself started in 2006, the index strategy it follows goes back way further. And over the last 30 years, that strategy has delivered a compound annual return of 9.37%. Think about that. This isn't just about collecting dividend checks. Over the long haul, this strategy has also provided really solid growth. It's a powerful one-two punch of income and appreciation. Now, what about the ride? Is it a roller coaster or a smooth cruise? Well, for that, we look at something called beta. It's just a fancy way of measuring volatility. The overall market has a beta of exactly 1.0. VYM's beta is 0.79. This is a key feature. It means that historically, VYM has been about 21% less jumpy than the market as a whole. So when the market takes a big dive or a big leap, VYM's moves tend to be a bit more muted, a bit more gentle. For a lot of people, that smoother ride is exactly what they're looking for.
And to really see where VYM fits, it helps to put it side by side with a fund that tracks the entire market, like VOO, the S&P 500 ETF. They're just different tools for different jobs. VOO is all about capturing the growth of the whole market. VYM is built for income and a less bumpy ride. You wouldn't buy a hammer to saw a piece of wood, right? In the same way, you don't really own VYM expecting it to beat the S&P 500 when tech stocks are flying high. You own it for that potentially steady income and lower volatility.
But let's be real, every investment has a flip side. There are no free lunches, and VYM is no exception. It's really important to know the potential risks. For one, when interest rates are high, super safe government bonds can start looking pretty good compared to dividend stocks, and that can hurt VYM's value. Also, its performance is definitely linked to how well big sectors like financials and energy are doing. And remember, while these are stable companies, no dividend is ever truly guaranteed. And, as we said, when the market is in a full-on growth rally, VYM is almost certainly going to lag behind. These are the trade-offs.
Okay, we've looked under the hood, we've checked the performance, and we've acknowledged the pitfalls. So let's bring it all home. What's the final verdict on VYM? Who is this thing actually for?
You know, this summary quote from the analysis just hits the nail on the head. VYM is designed for a very specific mission, to give you a basket of big, dividend-paying companies that have those classic value characteristics. And its natural habitat is inside a portfolio that's built with income as a top priority.
So does this sound like you? Let's break it down. The perfect investor for VYM is probably someone who really wants that regular quarterly income stream. They're someone who sleeps better at night knowing their investments might be less volatile than the overall market. They're probably in it for the long haul, maybe building up an income source for retirement. And they definitely appreciate the safety of owning a little piece of hundreds of stable, well-established companies all at once.
And that really brings us to the final and most important question. It's the one you have to answer for yourself. Every investment portfolio needs an engine to drive it toward its destination. And after everything we've looked at today with VYM, you can ask, is the right engine for your journey the one built for steady income and a smoother ride? Or is it the one designed for high octane, maximum growth? The answer to that question will tell you almost everything you need to know.